Today, we look at one of the largest economies in Southeast Asia, which is Thailand. Compared to regional peers, economic growth has been rather modest in 2024. Indeed, GDP growth improved to an average of 2.3% year-on-year in the first 3 quarters of 2024, up from 1.9% in 2023. That said, the details of the GDP print revealed that the growth drivers were uneven. On the expenditure side, growth drivers were limited to export growth and modest improvements in government spending. Meanwhile, a similarly uneven growth pattern was also reflected on the supply side. For 4Q24, hopes are pinned on a stronger turnaround in household spending, given by the implementation of the first phase of the digital wallet program in late September. We expect the economy to grow 2.6% year-on-year in 2024, implying a pickup in 4Q24 GDP growth to 3.5%. The Ministry of Finance and other public institutions expect 2024 GDP growth forecast of between 2.6 to 2.8%. For 2025, we expect GDP growth to pick up to 3.3% year-on-year. The timing of digital wallet disbursement suggests that the impact on growth will be felt in the fourth quarter of 2024 and the first half of 2025. Nevertheless, beyond the impact of digital wallet program, households are constrained by volatile wage growth and elevated household debt levels. Although agricultural wages are up 11.1% year-on-year in the first 3 quarters of 2024, overall wage has been flat due to a contraction in non-agricultural wage growth. This situation likely continues to be a source of stress for households regarding debt servicing, which could partly explain the elevated levels of household debt. Policy and political continuity will help support investment spending in 2025 from an expected contraction in 2024. Public investment spending will likely reverse course from slower disbursements in FY24 due to the late approval of Budget 2024. The timely adoption of the FY25 budget and political continuity will likely lead to higher disbursements in FY25. Private investment spending, however, could remain subdued, but the increasing value of issued investment promotion certificates and the permitted construction area in industrial areas suggests that momentum will be better compared to 2024. On the external front, the recovery of the export sector gained momentum in 3Q24. However, the outlook is subjected to risk, including domestic structural headwinds and concerns of oversupply. Our baseline is for goods export growth to remain broadly stable at 3.8% year-on-year in 2025 versus 3.5% in 2024. This will be supported by stabilizing growth to key trading partners such as China, ASEAN, and the US. Crucially, our baseline GDP forecast does not account for potential tariffs from the US, but we have estimated the impact of potential tariffs on Thailand GDP growth under 3 different scenarios, which US President-elect Donald Trump had mentioned during his campaign trail. Under Scenario 1, where a 60% tariff is imposed on China's export to the US, we expect GDP growth to be 0.2 percentage points lower than our baseline. Meanwhile, the government remains ambitious for its tourism sector, pushing for higher tourist inflows of 40 million tourist arrivals in 2025. We expect tourism prospects to remain robust, not least because of further measures boosted by domestic tourism, following the Cabinet's approval for 2 additional holidays in 2025. Strong tourist arrivals, alongside better goods export growth, will support a wider current account surplus for 2025 at 0.8% of GDP versus our forecast of 0.6% of GDP in 2024. In terms of the fiscal profile, Budget 2025 was approved during ex-PM Srettha Thavisin's tenure. Fundamentally, there were few changes to PM Paetongtarn Shinawatра's policy compared to her predecessors. The focus of fiscal policies remains to support economic growth. The fiscal deficit is forecast to widen to 4.4% of GDP in FY25 from 4.3% of GDP in FY24. Moving on to inflation. Inflation has been well contained in 2024 as the government's cost of living measures, as well as the abundant produce on key food items, have kept prices in check. In 2025, we expect headline inflation to average 2.2% year-on-year, up from 0.4% in 2024, putting it comfortably within BOT's 1 to 3% target range. Our baseline accounts for further upward revisions to retail fuel prices from 4Q24 onwards, as well as some upward adjustments to electric tariffs in 2025. The risk is that the government continues to bear losses on the oil fund to cross-subsidize retail oil prices, implying that headline inflation could remain low even next year. So, what does this mean for monetary policy ahead? Well, we think the pressure on the BOT to cut rates will unlikely be alleviated. The BOT is expected to face pressure to deliver rate cuts to support the government's goal of achieving higher economic growth. However, the impact of lower rates remains an open question, given that the growth constraints are structural rather than cyclical.